welcome to the deep dive. If you've ever glanced at the balance sheet of a big industrial company, maybe an airline or manufacturer, you're seeing just massive amounts tied up in physical things: factories, pipelines, aircraft, oil rigs, really the tangible physical foundation of their whole operation.
Absolutely. And that physical wealth, what accountants call property, plant, and equipment, or PPE, it presents a really fascinating puzzle. It's not just about what it costs to buy initially.
Right.
You've got to track its economic story, its value, sometimes over decades. And that means diving into
And that's exactly our mission today. We're going to walk through the key international accounting standards, IA 16, 20, 23, and 40, to really unpack the financial life of these major assets, from the first shovel in the ground right through to when they're eventually sold off. So this dive is for you if you want to get under the hood of how companies report their physical assets. Okay, let's start right at the beginning. Getting the asset onto the books. Initial measurement. IA 16 sets the ground rules, doesn't it?
It does. Two main criteria. First, it's got to be probable, likely that the asset will bring in future economic benefits, cash flows essentially.
Right.
And second, you have to be able to measure its cost reliably. If you can't pin down the cost, you can't really recognize it as an asset under this standard.
And that cost, it's more than just the purchase price, I assume.
Oh, much more. iOS 16 is very clear. You capitalize all the costs needed to bring that asset to the location and condition necessary for it to operate as management intended. So yeah, the invoice price, obviously. But also things like import duties, any non-refundable purchase taxes, delivery costs, site preparation, installation, testing costs, even professional fees like legal or engineering costs directly related to getting it ready.
So basically everything until you can flip the switch and it does what it's supposed to do.
Exactly. But, and this is a big but, the standards we looked at are also really specific about what not to include.
Ah, right. I saw that. Things like abnormal costs.
Precisely. Let's say you're building that factory and there's a major construction stoppage, maybe a strike, and you rack up $9 million in extra labor costs you totally didn't anticipate.
That doesn't get added to the factory's cost.
Nope, that's considered an abnormal cost. Or maybe materials get spoiled because of a design flaw early on. Those kinds of costs, inefficiencies, unexpected waste, they don't represent future economic benefit. They're written off immediately as an expense in the period they happen.
So you can't inflate the asset's value with, well, mistakes or inefficiencies.
That's the principle. Keep the asset cost reflecting the necessary investment to get it operational.
Okay, that distinction is clear. But then there's this other really interesting element. Costs you haven't even paid yet, but you still have to include up front.
Yes. This often surprises people. It's the requirement to capitalize the estimated future cost of dismantling and removing the asset and restoring the site if there's an obligation to do so.
Like the oil rig example we saw in the materials.
Perfect example. Say the rig costs $10 million to build today, but, legally or contractually, that in 20 years you have to spend, let's say, an estimated $4 million to remove it safely.
You can't just wait 20 years and expense the $4 million then.
No, you can't. Accounting standards, specifically IAS 37 on provisions, require you to recognize that liability now, but you don't add the full $4 million to the asset cost today.
Ah, because of the time value of money.
Exactly. You have to calculate the present value of that future $4 million outflow. So if you use a discount rate, let's say 5%, reflecting the risk and time, the present value of $4 million in 20 years is roughly $1.5 million.
So the oil rig actually goes onto the balance sheet at $11.5 million, 10-meter construction plus 1.5-meter PV of removal.
Correct. You capitalize that $1.5 million as part of the initial cost. And at the same time, you recognize a provision, a liability, for the same amount.
And what happens to that $1.5 million liability over the 20 years?
It grows. Each year, you accrete interest on it, effectively unwinding the discount. That interest accretion is charged as a finance cost, an expense, in your profit or loss statement each year. So over the 20 years, the liability gradually increases back up towards the expected $4 million removal cost.
Okay, wow. That connects asset costs, liabilities, and future interest charges right from day one. Very neat.
It's a key part of reflecting the true economic commitment involved.
Speaking of interest charges, this brings us neatly to borrowing costs. IAS 23, right?
Yep, IAS 23. This standard deals specifically with interest and other costs incurred in relation to borrowing funds.
And it applies particularly to what they call qualifying assets.
That's right. A qualifying asset is one that, by its nature, takes a substantial period of time to get ready for its intended use or sale. Think big projects. Building a power station, Constructing a skyscraper, developing a large software platform, maturing whiskey.
Maturing whiskey. Oh, okay.
Hey, it takes time. So the core rule in IAS 23 is pretty strict.
Which is?
If you borrow funds specifically to finance the acquisition, construction, or production of one of these qualifying assets, the borrowing costs directly attributable to that activity must be capitalized.
Must be. No choice.
No choice. It's mandatory. You add those borrowing costs directly to the cost of the asset during the construction period.
Okay, what if a company doesn't take out a specific loan for the project? What if they just use money from their general corporate borrowings, like a mix of different loans?
Good question. If funds come from a general pool, you can't just pick the cheapest loan rate. You have to calculate the weighted average cost of all the borrowings that were outstanding during the period, excluding specific project loans.
All right, I saw an example. Like if you had $10 million borrowed at 6% and another $2 million at 8%.
You'd calculate the weighted average rate. In that case, it works out to be 6.33%. And that's the rate you apply to the expenditures on the qualifying asset to figure out how much interest to capitalize.
Got it. It ensures a fair reflection of the company's general funding cost. And when does this capitalization stop?
It stops when substantially all the activities necessary to prepare the qualifying asset for its intended use or sale are complete.
Even if the asset isn't actually being used yet. Say there's a delay, maybe an industrial dispute after construction finished.
Even then, once it's substantially complete, capitalization ceases. Any further borrowing costs after that point just get expensed directly to profit or loss as they're incurred. The construction phase is over, financially speaking.
Okay, so we've built the asset, figured out its true initial cost, including borrowing and future dismantling. Now we move into its operational life. Section 2. Depreciation and what happens next.
Right. Depreciation. It's the mechanism for spreading that initial cost over the period the asset is expected to generate benefits. It's defined as the systematic allocation of the depreciable amount.
Which is cost minus residual value, right? The bit you expect to get back at the end.
Exactly. Cost less residual value allocated over the asset's useful life. And IAS 16 makes a point. Depreciation doesn't stop just because an asset becomes idle temporarily unless it's fully depreciated already or classified as held for sale.
Why is that, if it's not being used?
Because depreciation reflects the consumption of economic benefits, which often happens through wear and tear, technological obsolescence, or just the passage of time, not just active usage. An idle machine might still become outdated.
Makes sense. What if a company decides its initial estimate for depreciation was wrong? Maybe they changed the method from straight line to, say, reducing balance.
That's treated as a change in an accounting estimate.
And why is that estimate label important?
It's crucial for how it impacts the accounts. A change in policy usually requires retrospective application, meaning you have to go back and restate previous year's figures, which can be complex and costly.
Okay.
But a change in estimate, like changing the depreciation method or useful life, is applied prospectively. You just adjust the depreciation charge for the current and future periods based on the remaining carrying amount and the revised estimate. It reflects new information, not correcting an old mistake.
Simpler to handle then. Now, probably the most common judgment call managers face: spending more money on an asset you already own, subsequent expenditure. How do you decide if it's an asset improvement or just a repair?
This is absolutely key. You capitalize subsequent expenditure, add it to the asset's cost only if it's probable that future economic benefits beyond what was originally expected will flow to the entity.
So it has to actually enhance the asset.
Yes, enhance it. Maybe extend its useful life, significantly increase its production capacity, improve the quality of output, or enable substantial cost savings. Or, importantly, if it involves replacing a major component.
And if it just keeps the asset running as it was originally intended, like routine maintenance.
That's an expense. Straight to the profit or loss statement. Think oil changes, regular servicing, minor repairs. They maintain the asset's earning capacity. They don't enhance it beyond the original standard.
So let's say a $10,000 annual service contract for machinery expense. But spending $20,000 on a new part that doubles the machine's output speed.
Capitalize. Add that $20,000 to the machine's carrying amount and depreciate it over its remaining useful life, or the life of the new part if shorter.
This leads us to component accounting, doesn't it? especially for complex assets.
Exactly. For things like aircraft, ships, or large plants, IAS 16 requires that if an asset comprises significant parts with different useful lives, each part should be accounted for and depreciated separately.
The aircraft example was quite clear on this. The main airframe might last, say, 25 years.
Right, but maybe regulations mandate a major engine overhaul, essentially a replacement of key engine parts every 5 years. And that overhaul costs, say, $6 million.
You don't just expense that $6 million.
No. That $6 million overhaul cost is treated as replacing a separate component. It's capitalized as part of the aircraft's cost, but depreciated separately over its own 5-year useful life until the next overhaul is due. The original cost attributed to the old engine parts being replaced would be derecognized.
So the total aircraft value on the balance sheet reflects the airframe depreciating over 25 years, and this engine component depreciating over 5 years simultaneously.
Precisely. It gives a much truer picture of the consumption of economic benefits for complex assets. Requires more detailed record keeping, but it's more accurate.
Okay, now let's shift gears to how the value itself can change dramatically on the balance sheet. After initial recognition, IAS 16 allows a choice.
Big policy choice. The cost model or the revaluation model.
Cost model is straightforward, right? Costs less accumulated depreciation and any impairment losses.
Yep. Simple, historical, cost-based. But the revaluation model, that's where things get more dynamic and arguably more complex.
So under the revaluation model, you carry the asset at its fair value.
At a revalued amount, which is its fair value at the date of the revaluation, less any subsequent accumulated depreciation and impairment. And these revaluations need to be done regularly enough so the carrying amount doesn't differ materially from fair value.
Okay, the big question. What happens when the fair value goes up? If you revalue a building upwards by, say, $5 million, where does that gain go?
Not to profit or loss. This is crucial. A revaluation gain is recognized in other comprehensive income, OCI.
OCI. Remind us what that is again?
OCI is a section of the financial statements that captures certain gains and losses that aren't part of the company's regular trading profit or loss. Think of unrealized gains on certain investments, foreign currency translation adjustments, and these revaluation gains on PPE.
And these OCI gains accumulate somewhere.
Yes, they build up in an equity reserve, often called the revaluation surplus. It represents unrealized capital appreciation tied up in the assets. Importantly, it's generally not distributable to shareholders as dividends.
Okay, so upward movements go to OCI, build equity. What about downward movements if the asset's value drops?
Generally, a revaluation decrease, or loss, is recognized immediately in the statement of profit or loss, P&L. It reduces the current period's reported profit. Unless there's an existing credit balance in the revaluation surplus for that specific asset from previous upward revaluations. If there is, the loss first reduces that surplus in OCI. Only any excess loss beyond the existing surplus hits the P&L.
So you reverse previous gains before you hit the profit statement with a loss.
Exactly. It prevents companies from, say, revaluing up 1 year, boosting equity via OCI, and then taking a big loss through P&L next year if the value drops back down.
Now, the really interesting bit you flagged, disposal. What happens to that revaluation surplus balance when the asset is finally sold? Let's say it's got millions sitting in there from years of upward revaluations.
When the asset is derecognized, sold, or scrapped, any remaining balance in the revaluation surplus relating to that specific asset is transferred directly to retained earnings.
Directly. It never goes through the profit or loss statement.
Never. It bypasses P&L entirely.
So hang on. If I bought land for $1 million, revalued it over time to $10 million, so $9 million sits in revaluation surplus, and then I sell it for $11 million.
Okay.
The profit hitting my P&L on disposal is only $1 million. The difference between the sale price of 11 million and the last carrying amount of $10.
That's correct. The $1 million difference between the final carrying amount and the proceeds hits P&L as gain on disposal.
But the $9 million that accumulated in OCI over the years just gets shuffled sideways within equity, from revaluation surplus to retained earnings.
Exactly. It becomes part of distributable reserves at that point, but it never inflates the reported profit from the sale itself. It keeps capital gains distinct from operating profit.
That's a fundamental difference in how profit is presented compared to just selling an asset held under the cost model. Wow.
It really is a very important distinction when analyzing companies using this model.
Okay, let's touch on another factor influencing asset cost: government grants, IAS 20.
Right. Governments sometimes provide grants to encourage companies to acquire assets, maybe in specific regions or industries. IAS 20 covers how to account for these. First, you only recognize the grant income when you're reasonably sure you'll receive it and you've complied with any conditions attached.
Prudence and accruals, basically.
You got it. Now, for grants related specifically to acquiring non-current assets, capital grants, the standard actually allows two different accounting methods. Management gets a choice.
Okay, what's method one?
Method one is the deduction method. You simply deduct the amount of the grant from the initial cost of the asset.
So if an asset costs $5 million and you get a $1 million grant, you record the asset at $4 million.
Exactly. The main effect is that your depreciation charge will be lower over the asset's life because you're depreciating a smaller initial cost.
Okay, method two.
Method two treats the grant as deferred income. You record the asset at its full cost, $5 million in our example. The $1 million grant is recognized as a liability deferred income on the balance sheet.
A liability. Why?
Because you haven't earned it yet in an accounting sense. You earn it over the life of the asset it relates to. So you release that deferred income liability systematically to the P&L over the asset's useful life.
Ah, so you recognize a portion of that $1 million as income each year.
Yes, usually in line with the depreciation charge on the asset it funded. So the grant income effectively offsets the depreciation expense in the P&L over the years.
So same grant, same asset, but method one gives you lower depreciation expense, while method two gives you higher depreciation, but also offsetting grant income in the P&L.
That's the choice. Both are acceptable under IAS 20. It means management can influence reported profit profiles just by choosing the grant accounting method.
Another area where judgment significantly impacts the numbers. Okay, final section, different category altogether, investment property, IAS 40.
Right. This standard carves out a specific type of property. Investment property is defined quite narrowly. It's land or buildings or both held to earn rental income or for capital appreciation or both.
The key is it's not used in the company's own production or supply of goods or services or for administration.
Exactly. It's not owner-occupied property like a head office or a factory. That's IAS 16. It's held purely as an investment. Think of a company owning an office block that it rents out to tenants.
In accounting-wise, IAS 40, again, offers a choice after initial recognition.
It does. Similar to IAS 16, you can choose the cost model, which works exactly the same, cost less accumulated depreciation and impairment, or you can choose the fair value model. And this is where IAS 40 really diverges.
How so?
If you choose the fair value model for investment property, you revalue the property to its fair value at the end of each reporting period.
Okay, like the revaluation model under IAS 16.
But with two massive differences. First, under the IAS 40 fair value model, no depreciation is charged on the investment property.
None at all.
None. The logic is that the fair value changes implicitly capture the wear and tear or obsolescence. And second, and this is the big one, any gain or loss arising from the change in fair value is recognized directly in the statement of profit or loss for the period in which it arises.
Wait, under IAS 16, revaluation gains went to OCI, bypassing P&L. Why do fair value gains on investment property hit P&L immediately?
Because the standard views the performance of investment property differently. Its core purpose is generating returns through rent and capital appreciation. Therefore, changes in its fair value are considered part of the entity's performance for the period and should be reflected in profit or loss. It's fundamentally different from an operational asset like a factory, where value changes are seen as more incidental.
So if a company using the fair value model under IAS 40 reports a huge profit, you need to check how much of that came from just market movements in their property portfolio, rather than actual operational success.
Absolutely. It makes the P&L potentially much more volatile and directly reflects market conditions for that property. No depreciation, smoothing things out, and gains and losses hitting the bottom line immediately.
The distinction between IAS 16 and IAS 40 treatment is stark.
It really highlights how the purpose for holding an asset drives the accounting treatment and the story the financial statements tell.
Okay, let's try and synthesize this. We've journeyed from just defining the initial cost, including those tricky future dismantling costs,
And capitalizing necessary borrowing costs.
through deciding what subsequent spending enhances an asset versus just maintaining it, like the aircraft overhaul example.
Then navigating the complexities of revaluation under IAS 16, with gains hitting OCI and that special disposal rule.
I'm comparing that to the very different fair value model for investment properties under IAS 40,
Right.
where gains hit profit directly and there's no depreciation. Plus, the choices involved with government grants.
It's a lot. I think the critical takeaway for you listening is how much judgment and choice management has within these standards. cost model versus revaluation, which grant method. These choices fundamentally alter reported profits and the look of the balance sheet, even when the underlying physical asset hasn't changed.
It underscores the importance of reading the accounting policy notes.
Definitely. You need to understand the choices made to interpret the numbers properly.
So maybe a final thought to leave people with. The source material constantly pushes towards fair value, especially on revaluation or when transferring assets between categories or at disposal. How comfortable should we be, really, relying on fair value, which is often an estimate based on sometimes volatile market conditions, to determine the final profit or loss reported on selling a tangible asset that might have been built and used for decades?
That's a great question. It blurs the line, doesn't it, between the historical fact of what something cost and the current estimate of what it's worth. Where does objective reporting end and subjective valuation begin, especially when it hits the bottom line profit figure? Something to ponder.
Indeed. Food for thought. That wraps up our deep dive on tangible, non-current assets.